Ada, good morning to you. We appreciate you joining us at this time.
Good morning.
Yeah, thank you. Since Tuesday when we had the other conversation early in the week, what has changed significantly for the better? Anything?
Yes, yesterday oil prices picked up slightly as figures from the second quarter GDP, Eurozone GDP growth came in, and the economy grew by 0.4% quarter on quarter and about 1.5% year on year. And most of this growth was from Germany as their imports and exports figures reached the highest level ever recorded. And as well, yesterday we saw that the Chinese equity market increased by 1.7%. So that's what pushed oil prices up as at yesterday. But now we see prices are declining again, and prices have plunged to about 3.9%, trading at approximately $47 per barrel. As the Bloomberg survey predicts that the U.S. crude inventories will decline by 4.7 million barrels to an average of 455.9 million barrels. I mean, although the crude inventories are still above 100 million barrels higher than 5-year seasonal average, so that's what pushing prices down. And as well, we have figures that came in from the Japanese and Chinese economic data. We saw that the Japanese core index fell 3.6% month on month, despite analysts expecting a growth of 3.7%. And as well, it declined 7.5% year on year. And we saw that the Chinese producer price index declined as well, 5.9%. And Chinese sales, car sales as well, declined about 1.3%. So these are falling. These are falling. Investors are worried that demand in the region, in the Asian region, will begin to slow again. So this is what pushing prices down at the moment.
Well, everybody's pumping oil. Some of us wish we have perhaps a well in our backyard, even at $47 a barrel. So Nigeria would have to revise its oil benchmark from $53 a barrel for 2016 fiscal appropriations, isn't it?
Yes, I mean, I believe that Nigeria have to try and set realistic goals. We cannot continue to set our benchmark. We can't keep our benchmark at $53 per barrel when prices are way below that at the moment. For 2015, looking forward, we believe that 2016, crude production might decline. We know that the U.S. crude production actually is declining. I mean, it's decreased month on month from May to July after its peak in April. As at June, the figures are about 9.3 million barrels per day. And analysts or top energy agencies believe that the U.S. crude production in 2016 will slow to an average of 9 million barrels per day, opposed to an average in 2015 of 9.4 million barrels per day. So looking forward, global demand will pick up faster. Global demand is expected to increase about 1.34% to average 93.9 million barrels per day. So in 2016, we believe there will be some sort of rebalancing, and prices might pick up slightly to about $60 per barrel. But in the second quarter, in the final quarter of 2015, we believe that we should see demand pick up as well, as most economies are entering the winter season. So the demand for oil might be higher then.
Now to ask for what you analysts, oil commodities market analysts, what your long-term view is for the oil market, because as we're having this conversation, and I'm sure you're tracking the markets perhaps a lot more than I do, crude oil is around 44.80 now for WTI. That has since recovered about almost 1.5% today. So does it look like we will keep this one step forward, two step backward in the short term? But if we were making it a long-term outlook, what's your forecast?
In the short term, we still expect a lot of volatility in the market. Prices might still range. Prices might still fall in between the $45 per barrel to at the most $55 per barrel. But we believe that in 2016 or 2017, prices might pick up prices might pick up slightly to about $60 per barrel as demand will pick up and production from non-OPEC organizations will drop.
Ada, let's hang it in there. Thank you very much for coming through.
Thank you.
We appreciate your time. Ada Akinnobi, who is research analyst at a financial derivatives company.